Welcome to the Deep Dive. Today we're tackling something that causes a lot of stress for taxpayers. IRS Publication 547.
Yeah, it's the rulebook for deducting losses from casualty, disaster, and theft. We're aiming to cut through some of that bureaucratic fog, especially for your 2024 returns.
Right. It's dense stuff. Our mission today is basically to distill these, highly technical rules into something you can actually use.
Exactly, especially because there are some major constraints on these deductions now, things that changed significantly starting back in 2018. We want to make that really clear.
Okay, let's start with the absolute basics, the definitions. These are like the gatekeepers, right? First up, casualty. What does the IRS actually mean by that?
Right. So a casualty is damage, destruction, or loss of your property. But the key part is how it happened. It has to result from an identifiable event that is sudden, unexpected, or unusual.
Sudden, unexpected, or unusual. That phrase seems critical.
It's fundamental. If the event doesn't tick all those boxes, you basically stop right there. No deduction, generally speaking.
Okay. And theft. Seems straightforward, but I bet there's an IRS twist.
There usually is, yeah. Theft means the illegal taking of your money or property. The crucial bit is with criminal intent, under whatever state law applies.
So not just someone borrowing something and forgetting to return it.
Definitely not. It covers things like burglary, larceny, sure, but also embezzlement, even kidnapping for ransom payments or getting property through fraud. It's quite broad.
Do you need, like, a police report or a conviction?
A conviction isn't strictly required, but you absolutely need proof. Verifiable evidence that the taking was illegal under state law. That's key.
Got it. And the third one was loss on deposits. Less common, maybe.
A bit more specific, yeah. This is when your bank or credit union, basically any financial institution, goes belly up, becomes insolvent or bankrupt.
And can you deduct that?
Sometimes, but usually since it's not tied to a physical event like a storm, it's generally only deductible if you happen to have personal casualty gains from some other event to offset it against.
Okay, that makes sense. And you mentioned a major constraint earlier. This seems like the perfect time to bring it up. It sounds like the single most important thing for listeners filing now.
It really is. This is the big one for individuals filing for tax years 2018 all the way through 2025, thanks to the Tax Cuts and Jobs Act of 2017.
Right, that legislation changed a lot.
It did. Before 2018, if your personal property, your house, your car, whatever, got damaged or stolen, maybe in a local flood that wasn't huge, you could often claim a deduction.
But now, that's changed.
Drastically.
Right.
Now, for personal use property stuff not used for business or making money, the loss is only deductible if it's linked to a federally declared disaster.
Wow. So only if the president officially declares it a disaster area.
Pretty much. The IRS calls this a federal casualty loss. So if, say, your house burns down in an isolated fire, tragic as that is, if it's not part of a federally declared disaster, you generally can't deduct that loss on your personal return anymore. That's the highest bar you have to clear.
Okay, so that federal declaration is paramount for almost everything personal. But let's circle back to that first filter you mentioned, sudden, unexpected, or unusual. We need to understand what the IRS means by those specific words.
Right, because they draw some fine lines here. Sudden means it has to be swift, not something gradual or progressive.
Okay, swift, like a lightning strike, not slow rot.
Exactly. Unexpected means it was ordinarily unanticipated, something you wouldn't normally expect to happen. And unusual means it's not a day-to-day thing, not part of normal wear and tear or activity.
So this is why things like slow leaks or general wear and tear don't count.
Precisely. It excludes that progressive deterioration. That's why, for example, steady weakening from just normal wind or weather usually isn't deductible. Most drought losses are out, too.
And the classic example they always use.
Termites. Or moth damage. It causes a lot of destruction, sure, but it happens gradually. It fails the sudden test.
I remember seeing an example about a family pet, too. That clarifies unexpected pretty well, doesn't it?
It does. Like if your brand new puppy chews up an expensive rug.
It happened to a friend of mine. Very upsetting.
Financially upsetting, yes, but deductible. Usually no. The IRS view is that damage from a pet isn't really unexpected or unusual in the context of, well, having a pet.
Okay. It's about the definition, not the emotional impact.
Exactly. And same goes for damage you cause intentionally or through willful negligence, like purposefully damaging something in anger or maybe really reckless driving causing an accident. That fails the unexpected test because it was intended or, highly likely to happen based on the actions.
So we have the basic rules, the common things that don't count.
Yeah.
But you mentioned there's a weird exception, something about drywall.
Yes. The corrosive drywall situation. Very specific. If you had losses because of that specific type of drywall installed between 2001 and 2009, there's a special procedure where you can treat it as a casualty loss.
Okay, so that's deductible then.
Well, here's the catch. Remember the big rule. It still has to be tied to a federally declared disaster for personal use property deduction between 2018 and 2025. Since corrosive drywall issues usually aren't part of a declared disaster.
So it only helps if you have other casualty gains to offset.
You got it. It slots into that narrow exception for offsetting personal casualty gains. It doesn't magically make it deductible otherwise during this period.
Okay, that clarifies that niche rule. So assuming you do have a loss potentially linked to a federally declared disaster, let's dive into that structure. You said there are different types of disaster situations.
Right. It gets a bit layered. There are 3 key terms to know. First, the basic one, federally declared disaster. That's just when the president issues a declaration under the Stafford Act, triggering federal aid.
That's the starting point.
Yes. Then, if your loss happens because of that declared disaster and it's in an area eligible for assistance, that's called a disaster loss. This applies broadly: individuals, businesses, S-corp partnerships.
Okay, federally declared leads to a disaster loss.
Yeah.
What's the third term?
The third term is kind of a special category with better benefits: qualified disaster loss. This is a subset covering specific, major, often time-bound disasters. Think Hurricane Harvey, those big California wildfires in 2017, and certain major disasters declared between January 1st, 2020 and February 10th, 2025.
Okay. Federally declared disaster loss, qualified disaster loss. Why the 3 tiers if they all start with a presidential declaration?
It really comes down to the tax treatment, the calculation, and the benefits you get. That qualified disaster loss status, that's the one that unlocks the best tax relief, the stuff we'll get into with the calculation.
Okay, so getting that qualified label is a big deal.
Huge. And it's important to note, the source material explicitly says this qualified definition does not cover disasters declared only because of COVID-19. That's a specific exclusion.
Good to know. So classification is crucial. Now, you mentioned benefits. What's the immediate advantage if your loss is classified as a disaster loss, even just a broader category?
This is a really helpful rule. If you have a disaster loss, you can choose to deduct that loss not in the year it happened, but on the tax return for the year immediately before it happened.
Wait, so if a hurricane hits my town in, say, August 2024,
You could potentially file an amended 2023 tax return right away, claim the loss there, and maybe get a refund much, much faster than waiting until you file your 2024 taxes next year.
that's significant. Immediate cash flow help when you probably need it most.
Exactly. For people filing on a calendar year, a 2024 disaster loss could be claimed on an amended 2023 return. And you usually get extra time to make that choice, often until October 15th of the year after the disaster year. So for a 2024 disaster, maybe until October 15th, 2025.
Okay, that's a major planning point. What about the flip side? Not deductions, but aid received. There's new info on relief payments not being taxable, right?
Yes, this is also really important relief. Certain payments you receive specifically for disaster relief are not counted as taxable income.
Like what kind of payments?
Well, the main category is qualified disaster relief payments. These are amounts you get for reasonable and necessary expenses. Think personal needs, living costs, temporary housing because of a federally declared disaster. That money doesn't add to your tax burden.
And the publication mentioned some very specific recent examples, too.
It did. For instance, qualified wildfire relief payments. If you received payments between 2020 and 2025 related to certain wildfire disasters, that money is generally non-taxable. And this can cover things like lost wages, personal injury compensation, even emotional distress payments.
Wow, that's broad.
It is. And another very specific one mentioned is relief related to the East Palestine, Ohio train derailment back in February 2023. Payments received for that specific event are also designated as non-taxable. It shows they adapt these rules for major specific incidents.
Okay, that's good context on the relief side. But
Yeah.
now, the math. Section 3, calculating the actual loss amount. This always seems like the trickiest part. Where do you even start?
It is complex, but there's a formula. You start by figuring out 2 numbers and you take the smaller one.
Okay, what are the 2 numbers?
Number 1 is your adjusted basis in the property. Number 2 is the decrease in its fair market value, FMV. right after the event.
Hold on, adjusted basis. Let's unpack that. What is that exactly for our listeners?
Good point. Adjusted basis is basically your investment in the property for tax purposes. It generally starts with what you originally paid for it.
Your cost.
Right, your initial cost. Plus, you add the cost of any significant capital improvements you've made over the years, like a new roof, an addition, things that add value or prolong its life. You subtract any depreciation you might have claimed if it was business property, but for personal property, it's mostly cost plus improvements.
Okay, so your tax investment. You compare that to the drop in market value caused by the disaster. Take the smaller of those two numbers. Then what?
Then, from that smaller number, you subtract any insurance payments or other reimbursements you received or expect to receive.
Ah, so you only deduct your unreimbursed loss.
Exactly. That final figure smaller of basis, or FMV drop, minus reimbursements, that's your starting loss figure before the next set of hurdles.
Got it. And there's a specific rule for calculating the FMV drop for a house, right?
Yes, for your personal home, the house, the land, landscaping, etc., you generally treat it all as one single item when figuring out the decrease in fair market value. You look at the value drop for the entire property package, not piece by piece.
Okay, makes sense. Now, the hurdles you mentioned, the infamous two deduction reduction rules, these apply specifically to federal casualty losses for individuals, right?
That's right. These are the rules that significantly limit the final deduction for most people. Rule number 1 is the $100 rule.
The $100 rule, how does that work?
You have to reduce your total loss from each separate casualty or theft event by $100. So if one storm damages both your roof and your car, that's one single event, $100 reduction applied to the total loss from that storm. It's not $100 off for the roof and another $100 off for the car.
$100 per event.
Okay.
But you said earlier that qualified disaster loss status had better benefits. Does that change this rule?
It does, slightly. For those specific qualified disaster losses, the reduction isn't $100, it's increased to $500 per event.
Wait, it goes up to $500? That sounds worse, not better.
It seems counterintuitive, right? But hold that thought, because the next rule is where the qualified disaster loss status really shines.
Okay, what's the next rule? The big one.
The big one, the 10% AGI rule. This is often the killer limitation. After you apply the $100 or $500 reduction, you then have to reduce your remaining total casualty and theft losses for the year by 10% of your adjusted gross income, AGI.
10% of AGI. Remind us what AGI is again.
Adjusted gross income. It's basically your gross income minus certain specific deductions, things like student loan interest, contributions to a traditional IRA. It's a key number on your tax return, line 11 on the Form 1040 usually.
Okay, so if your AGI is, say, $100,000, you lose the first $10,000 of your calculated casualty loss.
Exactly. Your loss has to exceed 10% of your AGI before you can deduct anything above that threshold. For many people, their losses, even if substantial, don't clear that 10% hurdle.
That wipes out a lot of deductions.
Yeah.
But what about the qualified disaster loss status? You hinted it helps here.
This is the jackpot. If your loss qualifies as a qualified disaster loss, that 10% AGI reduction rule does not apply. It's waived entirely.
Wow. Okay, that's why the $500 instead of a $100 reduction doesn't really matter as much. You skip the much bigger 10% AGI hit altogether.
Precisely. That is the huge financial benefit of having a loss classified as a qualified disaster loss versus just a regular federal casualty loss. If your AGI is $150,000, that's $15,000 in loss reduction you don't have to take. It's a massive difference.
That single difference in classification could mean thousands of dollars back or nothing. That really underscores why knowing the exact type of disaster declaration is so critical.
Absolutely non-negotiable if you want to maximize any potential tax relief. You need to check the FEMA declarations and understand how your event was classified.
Okay, what about the scenario where insurance is actually pretty good, maybe even more than your basis in the property? Can you have a gain?
You certainly can. A gain happens if the reimbursement you get, insurance, etc., is more than your adjusted basis in the property that was damaged or destroyed.
And that gain is taxable income.
Generally, yes, you'd have to report it, but there's often relief available here, too. You can usually choose to postpone reporting that gain.
How do you postpone it?
By buying replacement property. If you reinvest the proceeds into property that's similar or related in service or use to the property you lost, you can defer the tax on the gain.
Is there a deadline for buying the replacement property?
Yes, there's a replacement period. Generally, it ends 2 years after the close of the first tax year in which you realize any part of the gain. So if you got the insurance money and realized the gain in 2024, you usually have until the end of 2026 to replace the property.
2-year standard. Is it different if you're in one of those disaster areas?
It is. Another benefit. If the loss involved your main home or its contents, and it was located in a federally declared disaster area, the replacement period gets extended significantly to 4 years after the close of the tax year you realize the gain.
4 years. That's much more breathing room to rebuild or find a suitable new place.
Definitely. It recognizes the practical difficulties after a major disaster.
And wasn't there one more special rule? Something about insurance money for just like everyday stuff inside the house?
Yes, another practical break for homeowners in disaster areas. If you receive insurance money for unscheduled personal property, but clothes, furniture, kitchen gadgets, stuff that wasn't specifically listed or itemized on your policy.
Your general contents coverage.
Right. Any insurance proceeds you get for those items are not counted as a gain at all. You don't have to track the basis of every single fork and sock. That part of the insurance payout is simply tax-free.
That simplifies things immensely.
It does. And furthermore, for calculating any potential gain on the rest of it, your house structure and any scheduled items, like jewelry listed separately, they're generally treated as a single item along with the house itself. Again, simplifying the gain calculation.
Okay, we've covered a lot of ground. Let's try to synthesize this. For someone listening, dealing with a loss as they prepare their 2024 taxes, what's the absolute #1 takeaway?
The threshold, the big one. For personal use property losses between 2018 and 2025, step 1 is always, is this loss attributable to a federally declared disaster?
If the answer is no, you probably stop there for personal property.
Generally, yes. If the answer is yes, then step 2 is crucial. Was it designated as a qualified disaster loss? Because that's the key to potentially avoiding the big 10% AGI reduction.
And if you clear those hurdles, the calculation follows those steps we discussed. Smaller basis or FMV drop, minus insurance, then the $100 or $500 reduction, and finally maybe that 10% AGI reduction unless you hit the qualified disaster exception.
You've got it. It's a sequence. And this brings us back to something we touched on earlier, which makes for maybe a final provocative thought. We talked about adjusted basis.
Right, your cost plus improvements.
Yeah.
Crucial for the calculation.
Crucial. But here's the interesting bit. The costs you incur to figure out your loss, like paying for an appraisal report or hiring a photographer to document the damage, those specific costs are generally not deductible during this 2018-2025 period as a casualty loss deduction itself or as a miscellaneous itemized deduction.
Oh, so even though you need that appraisal, maybe, to prove the FMV drop, the cost of getting the appraisal isn't deductible itself.
Correct, under the current rules for most individual taxpayers. So why bother keeping meticulous records, especially of your basis, your original cost, all those home improvements over decades? If the loss deduction is so hard to get and the costs of proving it aren't deductible anyway.
Yeah, why bother?
Because basis isn't just about calculating a loss. It's absolutely critical for calculating a gain. If your insurance payout ends up being more than your adjusted basis, that difference is potentially taxable income. If you haven't kept good records of your initial cost and all those improvements that increased your basis over the years,
You could end up reporting a much larger gain and paying more tax than you should have.
exactly, you might not accurately reflect your true investment in the property. So even if you don't get a loss deduction, having solid proof of your basis can save you significant money if you end up in a gain situation. Record keeping pays off, whether it's for minimizing a gain or hopefully maximizing a loss deduction if you meet all the tough criteria.